So now we will move to the heart of our presentation, and I would like to introduce Joe Phillips, who is the CEO and Director of Macarthur Minerals. And Joe was previously the company's CEO in 2015 and was responsible for the original funding and development of the company's significant iron ore assets, having completed its 2012 pre-feasibility study for the Ring Hematite project and obtaining the environmental approvals. Mr. Phillips was educated at the University of Queensland, and he combines strong project management skills with a discipline in economics and a detailed understanding of the operation of public administrations and the elected governments in Australia. And Joe is joining us live from Australia. It's quite a bit earlier there than it is here. I believe it's Friday morning for Joe. So without further ado, Joe, I'd like to pass things over to you so you can begin the presentation.
Thanks very much. Can you see me all? Start the video. Here we go. Hi, one and all. Can you see me? All coming through? Okay, well, look, I'll pitch off. I might try the first slide, please, if somebody can move that forward. We're there? Here we go, and that's our disclaimer, and I certainly have all read that. Next slide, please. This is our corporate overview. Welcome, one and all. It's early in the morning over here, so I shan't join you for a glass of wine. But look, I've got a lot to say in a very short period of time, but this is our metrics in relation to our company. As you can see, Macarthur is trading pre-COVID-19 prices and valuation, which is a good sign. I think there'd be a lot of juniors that would dream about the day that they can get their stock price back to pre-COVID-19. The Macarthur strategy is very simple. I started with the company in 2009, took on the role as CEO in 2015. Macarthur's invested over $100 million Canadian in its projects in Australia. We went through the last super cycle. I remember in 2008-9 walking down Bay Street when Bloom Lake was coming through and it was the topic of the town. Iron ore pricing at that time was around about $100 a tonne, and everyone had high hopes in relation to the Bloom Lake investment. That's now been taken over by Champion Iron, and during the presentation I'll make a lot of references back to Champion Iron so people have a Canadian point of reference in relation to the iron ore project in Australia. As I said, we've spent a lot of money in the area. In the last super cycle, we drilled out 1.3 billion tonnes of magnetite ore, plus we delineated a hematite product, which we can bring to market. But the key thing for us over the last decade, our stumbling block has been our route to market. We had a big American as our neighbour next door, which was Cleveland Cliffs, or Cleveland Natural Resources, as they're called now. And they were very much responsible for consuming all of the capacity, iron ore capacity on the Esperance to Kalgoorlie, to our site rail line, and also the export capacity through Esperance. That dynamic has changed. Cliffs Natural Resources left Australian shores in June 2018, and we now have the ability to work with our rail and port providers to contract a route to market. Over and above that, 2018 was an important year for Macarthur when we finally contracted Glencore in relation to a life of mine offtake for our product. But we have a generational supply of iron ore. We have access to a network of rail and port infrastructure, and we are working diligently now to produce a bankable feasibility to fund that program. Next slide, please. A couple of things while the slides transition that you may not know is Macarthur Minerals is still very much a Canadian company. 68% of the shareholders in Macarthur Minerals are held by custodians in Canada and North America. The second largest shareholder in the company behind the custodians in Canada is me. I rank number 2, and you'll see board and management also coming in behind me. And one important fact is 87.9% of all of Macarthur's stock is held in the top 20 shareholders, of which management make a significant proportion. So that's very important. We have a valuable asset 1 billion tonnes of iron ore in anyone's language is a very important asset. And by having such a strong top 20 shareholding, it means that if anyone is moving forward with an opportunistic takeover, well, they've certainly got to pay a due price. Okay, let's have a look at this next foil. As you can see, Macarthur is surrounded by a $3.5 billion corporation called Mineral Resources Limited. Let me be very frank, we have all of the resource in the area. The areas in the orange are our assets, both Lake Giles, Trepo Grande, Mount Jackson North. We have a significant iron ore footprint. The assets of Trepo and Jackson haven't been explored yet, apart from some cursory reconnaissance geology. But they're resources for the future. But the Lake Giles project itself is a significant asset. It stretches over 800 square kilometres, and we've got an ore body that runs 7.5 kilometres by 80 to 120 metres wide and up to 1 kilometre deep. So it's a continuous mass of iron ore, quite unique in its structuring. Key points I'd like to make here is that currently Mineral Resources is exporting 6.1 million tonnes over the last 4 quarters. Now, if you listen to the media, they're doing 10 and 11 and 12 million tonnes. That's not the case. They're doing 6.1. They are targeting 11 million tonnes, but targeting 11 million tonnes and actually putting 11 million tonnes down a network and through a port are different matters. But let me be very specific, and I've got the numbers here from yesterday. They're currently moving in the last 12 months 6.130 million tonnes through a network that has a 15 to 20 million tonne capacity. So as you can see, Macarthur's focus is about getting access to rail networks, is about getting access to rail service providers, and about getting through the Esperance port. The company is committed to, by mid-year, to having a contracted position on the rail network, which means that with the completion of our bankable feasibility and funding, we have surety that we can get our project and our commodity to world markets. And as I said, Glencore is in the wings there to assist us in relation to a life of mine offtake of up to 4 million tonnes and getting our project and getting our commodity out to the world. Okay, next slide, please. That's just a quick resource statement. As you can see, our product in the ground is similar to what you're seeing in Bloom Lake. Our hematite product is a weathered cap that sits above the magnetite. Look, at this point in time, the hematites are nice to have. We don't have the tonnage to sustain a big capital investment there. So at some point, with access to markets through rail and port, Macarthur can exploit that resource. But at this point in time, it sits there. A couple of key highlights: our grind size is competitive. And if we move to the next slide, I'll talk about the permitting that we have. Since 2006, since Macarthur's been around, we've done over 250,000 metres of drilling. 250,000 metres of drilling. We've done hundreds of thousands of Davis tube testings, so we actually know that the material recovers well. We've cleared native title. We've cleared heritage. For our hematite, we've cleared environmental permitting, so we have the ability to extract the material on impact zones, and we've got granted mining leases. So that means that from a permitting perspective, apart from the permitting of the magnetite plant itself and associated structure, we've come a long way in relation to getting that through to production. So let's talk about the Moonshine Magnetite project itself. We have exactly the same OPEX figures as Bloom Lake, which is Champion Irons. Our figures in US dollars per tonne is $37.43 per tonne FOB, which delivers a plus 65, 66, 67, 68% iron product to the port. Now, currently that commodity is trading sub $110 per tonne US, and you've got to take into consideration the exchange rates. At the moment, Australia is trading about 65 cents to the US dollar. So, we have a significant exchange rate advantage. Now, let you cast your minds back to 2012, when the iron ore prices were very, very high and robust, about 170 US dollars per tonne. Australia had 105 to the US $1 exchange rate. We're at a very, very similar level today than when you take into consideration the exchange rate effects as we are back in 2011-12. In 2011-12, Macarthur had a market cap approaching $200 million. We were backed by major institutions out of Toronto and North America. Toronto Dominion was our champion in the market. And as I said, we had a very, very robust share price and market cap valuation. And I'm very keen to see those days return again. From a Capex perspective, we're looking at up to 4 million tonne, 3.4 million tonne production profile. It's only small to begin with, but it gets us into the market. It produces an honest $75 to $80 million revenue per year based upon those levels. And we have a Capex figure of direct and indirect of 326 million. That also contains 54 million in long-term remediation costs, as well as a $44 million contingent. So we have a digestible capital figure. And as you'll see later in the presentation, we're working with our partners out of New York to build in a funding strategy to do that. But the key things for us first is let's get a contracted route to market. Let's get our resources up into a measured reserve category, and that will allow us then to complete our bankable feasibility. In the short term, though, and this is a little bit extra, in the short term, Macarthur's looking at some low-hanging fruit. That is some low capex, short time to production iron ore assets in Australia that we may, I underline the word may, be able to acquire, which will give us some sustainable cash flow whilst this program of studies completes and as we move towards the production of our Lake Giles asset. But let me state that nothing underlines the importance of bringing this Lake Giles Moonshine project through to production. Next slide, please. The next slide talks about unlocking the value of Macarthur. Look, I've been with this company since 2009. I've been a major shareholder. I was a facilitator to acquire the company from the major shareholder, Ken Talbot, back in 2009. I have waited over a decade, and we have contracted and negotiated and visited with the West Australian government, who own the Esperance port, begging for access to the Esperance port. You'll see an area there in orange where we propose to put a 200 to 300,000 tonne storage shed. We are working now with authorities in relation to our own unloading facility, either on the port or off port, as a solution to getting access through to that bulk iron ore port at Esperance. As I mentioned before, currently it is idling at half capacity. Mineral Resources have put their hand up to take some additional tonnage, but at this point in time, since 2018, that port is idled along at half capacity. We're very, very keen to contract in a long-term take or pay Macarthur's opportunity to facilitate iron ore through that port. That will underpin long-term, and I'm talking plus 50-year job opportunities for both the Esperance and Goldfields communities and provide significant regional sustainable economic development for the Esperance Goldfield area. At the moment, there is no take or pay contracts that are currently running down the Esperance line or at the Esperance port, which means, let me just underline this as an important point, which means that if the iron ore price for 56, 58% iron ore drops, there is the opportunity for the current customer to turn off capacities through that network. And where does that leave the workers? Where does that leave the people in the Goldfields and people who have made Esperance their home? As I said, we're looking at underpinning that with long-term job and growth opportunities. Okay, so let's move on, please, to the next slide. I did foreshadow before that we are working with advisors out of New York, EAS advisors, Eddie Sugar's team. Eddie's ex-managing director of Jefferies. He's been very successful in funding iron ore projects. He's been working with us for some years now, and only recently in a contracted form to work with us to build up our book to allow us to fund the opportunities here in Australia. Next slide, please. And these are the important slides, because what we've seen is we've actually seen some major changes occurring in the world of iron ore. Next month, you'll see in the Dry Bulks magazine, I've got an article in relation to shipping charges. I'll circulate that around to all those people who are on this webinar today, but it's an interesting read, but I won't touch on that. What I'll touch on is I'll touch on steel. Steel is a key driver for demand for iron ore. Now, iron ore has two components. One is the demand for steel, and the other component is the supply of iron ore, and I'll touch on both of those. But look, let's talk about steel. The key drivers for steel and demand for iron ore is the Asian market. 1.5 billion tonnes of iron ore is consumed by China, Japan, Korea and Taiwan annually. 900 million tonnes of this comes out of Australia in the form of hematitic ores. 52 million tonnes comes out of it from Canada, so that'll give you some idea of scale. This region consumes 76% of the world's iron ore. So it's a very, very important market for the commodities that we're talking about. In Australia, the focus has traditionally been and continues to be on the hematite ore. That's the unprocessed 62 to 58% material, generally with high levels of impurity that goes across to the market. Less than 4% of that 900 million tonnes that leaves Australian shores annually, less than 4% is the high-grade 65% magnetite product. But the interesting thing is that the customers in China are demanding the higher-grade material, and on the next slide I'll explain why. But the next point I'll make is you can't beat geography. And Australia's very, very close to its world markets, which means that the cost of shipping to get our iron ore across to world markets is at least 50% below what it is from the North American and also from the Brazilian spaces. So we have a natural geographic advantage. So iron ore is here to stay. There's no doubt about that. Now, on the steel component side, in 2019, China consumed 27% of its own domestic steel production with its fixed assets, on its fixed assets creation. So that's its infrastructure. Okay, and that equates to an annual spend in RMB of 5.9 trillion RMB. So in 2019, they spent 5.9 trillion RMB. On the 22nd of May this year, 2020, to support domestic production, the Chinese National Congress allocated 4.7 trillion RMB as an economic stimulus package, of which, as I've mentioned before, 27% of that will go into fixed asset production. 43% of that stimulus historically has gone into the construction of property, domestic property, and the balance across the economy. Now, what you're seeing there is a doubling of steel demand domestically, in my mind, by China, based upon its economic stimulus. And that certainly will do a lot to foray the downturn in the export of iron ore, steel products out of China, especially to markets in Europe and the USA. That's come about by this COVID-19 downturn. So the key point that I want to make is, whilst there has been some external economic dampeners, and I'm using COVID-19 as an example, what you're seeing is the economic stimulus packages from China, but combine that with the trillions of dollars of economic stimulus packages that's has happened worldwide, and I see a very, very strong future for steel and therefore for iron ore demand. On the supply side, on the supply side, you've seen supply disruptions occurring out of Brazil. You see Brazil, sadly, in the grips of the COVID-19. You've seen weather disruptions out of Australia, and I think we're going to stay in a undersupplied scenario, a bit not as broad as some may attest, but I do see the iron ore price staying relatively robust for at least the next 24 months. And I'm not as pessimistic as some analysts that put figures out there at $70 and $76 US, but even at $70 and $76, our project still is very, very viable. But even at those figures, I can't see the prices coming down. And the other key point for us is in Australia, you've got to look at the exchange rate, because the exchange rate makes an enormous difference in the profitability of our business. So every time the exchange rate goes down to the US, Australian iron ore producers make money. Okay, next slide, please. The next slide talks about magnetite and the key drivers. And as you see, there's been a premium that's been driven even since 2016 for high-grade material. And what's driving that? Well, what's driving that is this. Customers in China have been forced to comply with new environmental regulation, which means that over 32 older style steel mills have been closed down over the last 24 months. Now, that product hasn't been lost. We haven't seen a reduction in steel production. It means that the newer furnaces that operate within the Chinese market are using cleaner, low impurity iron ore. And that's high-grade material, and that's magnetite styles and higher grade feeds coming out of Brazil. And why are they doing that? Because there's a metric that they use to optimize their furnaces. It's called slag volume index, SVI. And the lower your slag volume index, that's your waste material in your furnace, the higher your steel production that comes out of that furnace. Okay, so high-grade, low-impurity material creates a furnace efficiency. Furthermore, magnetite ores are exothermic, which means that you use less coking coal per tonne for each particular tonne of steel produced, and there's a cost saving. And finally, from an environmental perspective, magnetites are very, very low in sulfur, which means that from an air quality perspective, it's the clean steel feed stock for the future. Finally, and in addition to that, if you're given the low impurities, magnetite created steels are very, very low in impurity, which means that they're not as brittle as poorer quality material created by some hematitic products. So there is a demand for cleaner product. It's not easy for hematitic ores to be cleaned up to the levels of plus 65%, and in actual fact, the recoveries are poor. It's quite complicated. So my underlying point here is magnetite's here to stay. Macarthur is targeting a boutique magnetite resource. We aren't going to have an enormous impact on the world's supply in the short term, but with 1 billion tonnes resource, we certainly have the ability over time, once in production, to ramp up to be a meaningful provider of magnetite ores through Glencore to the world market. So that's our story. I'm very, very keen to listen to shareholders and also to field some questions. So I might pass back to you, Jordan, and solicit some questions.
Thanks so much, Joe. Yeah, we are now moving on to the Q&A section of the presentation. So there's been some questions that have come in already, but if anybody else is interested in asking some, there's a Q&A section of the webinar. Feel free to ask your questions there, and we will do our best to get to as many as we can. So Joe, if you're ready, here's a question for you. Do you expect to do any pelletization of your ore before shipping to increase the iron concentration and to reduce shipping costs per ton of the actual content?
Yep. Look, two things there. The answer is no in the short term, yes in the long term. A pelletization does increase the commercial value. It doesn't increase the iron content. It increases the commercial value. Pelletization takes a sub 45 micron a magnetite concentrate and turns it into a ball, which means that when it's introduced into the furnace, it doesn't smother heat. So that's the purpose of pelletization. In the short term, no. In the long term, yes. there is a significant uplift in the value of the product once it's pelletized. But as I said, our key goal in the medium term is to get our route to market contracted and to get our product into the market. We can then finesse the value equation once we have cash flow and once we've paid back our Capex after the first 3 years.
Great. Another one coming in here is, could you address the political risk with China?
The political risk, yeah, look, we have a saying in Australia, there's no point cutting off your nose to spite your face. And I don't know if that saying exists in North America. But that's an important saying. I mean, China's a valuable trading partner to Australia, a valuable trading partner. 54% of our exports go into that market. We are the largest supplier of iron. We are one of the largest suppliers of coking coal, thermal coal, natural gas, barley, beef, to mention milk products, to mention but a few. They are an important customer to us. We are an important supplier to them. I think it would be very negative for China to damage that relationship, and it would be equally as negative for Australia to damage that relationship. So I think sense will prevail. The Australian government, over the course of the last 4 or 5 years, has been tightening, I suppose, the Silk Road connections for China into Australia. But I think China expected some of that. I don't think they thought we were sufficiently naive that we weren't aware that there's been some resource banking, that there's been some investments made here that probably had a long-term interest for China and a short-term, and were to the short-term detriment of Australian asset owners. Look, it's a learning process. I think each country is intricately linked together. Each country is intrinsically linked together. I don't see any rationale for either party to go it alone.
Great.
Okay.
Another one here is, what are the catalysts for 2020?
In relation to iron ore, or in relation to economic development?
I feel like it's probably going to be more related to the economic development side of things. Macarthur specifically.
Look, the catalyst. Yeah, the catalyst for Macarthur is very specific, and I haven't shied away from the fact we have been working tirelessly, and I've got to use that word, in relation to getting our contracted route to market. Some of you that listen to commentary that gets posted indirectly on CEO CA will see that I did respond to a shareholder and said that, look, we are negotiating below rail contracts with Brookfield. They're the rail provider here. They're Canadian. We are negotiating on a dual front with both Horizon and other rail providers in relation to above rail assets. We are and have designed unloading facilities both off port and on port at Esperance. We have provided those studies and designs to the West Australian Government in the Southern Ports Corporation in an educative process to demonstrate to them that we can fit our capacity through that network. Now, that's the key thing. Now, the third thing as a catalyst is we have a resource statement coming out mid-year based upon the drilling that was completed last year. And then finally, what is critical for us is we have a generational supply of iron ore. So when you're talking billions of tonnes, we will be seeking above the long-term partnership we have with Glencore, a strategic investment partner. Now, that is a steel mill. Now, whether or not it's from Taiwan or Korea or Europe or India remains to be seen, but we will be seeking a strategic partner that has a long-term interest in in having a low-cost access to commodities to feed their mills. So, you know, any one of those will make a significant difference to Macarthur. Now, let me put a fine point on it, a fine point. In 2010, the Esperance Port Authority granted Macarthur priority access agreement in 2010. That means that when capacity was available, we were one of the first customers to be able to get access to that additional capacity. Our stock went from $1.20 to $4.30. So it's all about infrastructure. Whether we can get onto the networks, and I'm very comfortable that we should be able to, when we get onto the network, will have an enormous impact on the line of sight to cash flow that customers look for and investors look for when making their investment decisions. So they're the key catalysts for me. The other point that at a macro level that is the iron ore pricing. I think the iron ore price will remain robust for the next 24 months. I think that's going to be an important point as well. And I also think that you'll see a shift in demand away from low cost, high impurity product to demand for higher cost, higher iron, low impurity products as being demanded by some of the markets in the Asia Pacific area.
Okay, great.
Over to you.
Another one here is it possible to have Glencore finance the mine, either partially or entirely, seeing as they have a strategic offtake agreement with Macarthur? And as a kind of follow-on to that, does Glencore own any shares?
Yep, Glencore does. Glencore's a convertible note holder. It's got a significant proportion. It's got $2 million worth of convertible notes in Macarthur that can convert at any time. To answer your question, look, I can't speak on behalf of Glencore, and normally I attempt to, but my discussions with them have been along this vein. Glencore comes in when the project is nearing completion. So let's use the example of Champion Iron Ore. Glencore made their investment in Champion in the form of a debt facility, a board seat, and also a percentage of the offtake. And it was the last investor to come in, not the first. So let me say this, that they have been very supportive, and I've got to say Yottish and Peter Hill have been absolutely excellent to deal with. Nothing is too much trouble in relation to giving us some clarity around what's happening in global markets. They have been supportive of our listing here in Australia, and they continue to have monthly updates and catch-ups with Macarthur on the progress towards production. So we have a very strong commercial relationship. But in saying that, they want to see Macarthur stand on their own 2 feet, and that means that we have to finish our studies, we have to contract our route to market, we have to make sure that we can cost-effectively get product to the Esperance port. And at that point in time, if we're shy in relation to our debt financing or we've got some overruns, well, maybe we go cap in hand. But they're the last port of call, not the first.
Fair enough. Another one is, are you looking to do any raises in the near future?
Not in the short term. We had a successful year last year. We did our convertible note offering, as you're aware, of which Glencore took the cornerstone of that. And we also did an Australian listing. You know, that confused the Canadian market a little bit. They wanted to know why we did that. And it was purely about financing, because last year I visited and talked to over 130 institutional mining investment groups. And they all said, look, Joe, like the product, like the sector, reduce some of your risks. That is your route to market, your resource, get your bankable feasibility underway, and let's look at it again. And then the question that they asked me is, have you talked to the Australian mining institutions, because they're really across the risks associated with iron ore in your industry? And I said, no, I haven't. I said, the Canadian listed. I said, well, why are you Canadian listed? And I said, well, it's a matter of legacy, really. I mean, in 2006-7, when the asset was backed in, it was a Canadian asset, and so we've stayed there, and it's been a good market for us. It's better now. We've had a few tough years there where the Canadian market went down the rabbit hole of cannabis and blockchain, but we're now back with the good, honest mining investment opportunities. So we took the opportunity last year when things were drifting in relation to the sentiments for mining in the North American markets, and we linked into the Australian exchange. Look, it's been a good thing for us. We have picked up some great Australian shareholders, and some of them are on this call today. And I'm certain that they will support us through the next year. But in the short term, no new capital raisings. We may now, in saying that, I will premise it by we are looking at some short-term opportunities to create production profiles within a 12-month cycle. But if that comes to fruition, I'll retract that statement. But principally, we're looking at debt facilities to finance that. But there might be a small one. But if that doesn't occur, we don't really need to go to the market for additional cash. Okay.
Another one here is, can you just address the value proposition versus Champion?
Well, it's an interesting one. Champion stepped into an asset that was built by Consolidated Thompson, which was eventually sold to Cleveland Cliffs or Cliffs Natural Resources for $4.1 billion. Cliffs Natural Resources invested a further $1 billion and then turned it off. So the value proposition for Champion Iron is that they stepped in for the tune of $10 million, a very significant piece of infrastructure. Over and above that, they worked with the Quebec government to hand back the port and rail operation, which took some burden off them. And they then raised a further $360 million through Sprott and Glencore, through Duchenne at Sprott and Glencore, and they brought that back into production. Well, look, the market struggled in 17-18, the market struggled in understanding the value proposition for Champion because there was a lot of uncertainty about the iron ore pricing. But let's be very specific. They produce a Canadian per tonne FOB product at 66%. They deliver it to the port for about $53 Canadian, which is exactly the same OPEX figures in Australian dollars that we will deliver product, forecasting to deliver product to our port. Their capital intensity per tonne is exactly the same as ours. Now they've put on hold their expansion capacity from about 4 and a bit million tonnes up to 8 or 9. but they're producing between 4 and 5 million tonnes per annum in a run rate. Their market cap has gone from a modest $8 or $9 million in 2015-16 right up to, I think they've touched over $1 billion in the last 12 months. So that's the ramp up that that can occur. They have similar partners to us, being in Glencore. So they've stepped into the Champion Iron stepped into the shoes of a producing asset that just needs to be fine-tuned. They've picked a run-up in the market in relation to iron ore. They're also producing a commodity that's very much in demand. They're producing a concentrate. They're not producing a pellet at this point in time. And they have very, very similar OPEX metrics and Capex metrics to Macarthur. So I think that's as strong a parallel as I can make.
Okay, great. Another one here is, you suggest initial sales of $75 million. What kind of margin might be achieved on this?
Yeah, we used a long-term iron ore price based in our analysis. So let me be very clear. We used a long-term iron ore price of $86 US or 65+% iron. Okay. Champion Iron in their bankable feasibility used $84 US. So hence the margin. At the moment, the margins are higher. We deliver product to the port for about, based upon a 70-cent exchange rate, to $38 US. And currently plus 65% product is selling at spot above $110 US per tonne. So you can see the margin. The margin is quite substantial.
Mm-hmm.
Now, the $85, that figure, the $85 figure is what we published in our economic analysis last year, and it's based upon a long-term iron ore price. Hence the difference between the two scenarios.
Gotcha. And you said you have a 50% advantage in shipping cost versus North American mines. Do you have an idea of what's the saving in dollar cost per ton?
Anything between $8 and $12 US.
Gotcha.
Well, quite significant.
Very much so.
Look, it's purely distance. It's purely distance. You know, and what you've got is a contagion of events at the moment. You've got a dip in demand in relation to shipping out of South America. You know, due to a range of reasons I've raised earlier. You've got a falling in the ore price, and all of that's impacting directly upon the cost of shipping. And then overlay that with geography. You know, you know, you've got quite a significant advantage coming out of this phase.
Absolutely. Just one thing here. What dilution can we expect, do you think?
Yeah, I've answered that before, and in the short term, you know, we won't be going back to the market to seek additional funding. Now, I premise that by saying if there is an opportunity to get us into production in the short term, you know, that may change, and you know, we are looking at options there. Principally, Macarthur, from a funding strategy that's being driven out of EAS in New York, we're looking at debt, and we're looking at a minimum of 65% debt. Overlay that with a strategic investor, and I'd like a strategic investor to either take 20% of the project or a percentage equity in the company itself, but principally in the project. I'd like them to take it at a project level, and then overlay that with third-party providers of and funders of unloading and rail infrastructure. You know, look, I don't see. As I said, I'm the second largest shareholder. It's not in my interest to dilute myself out the back door, but you know, we're finessing the funding strategy to minimise the dilution to shareholders. That's probably the best answer I can give you.
Gotcha. I'm just asking this question here. We are running out of time. If we haven't gotten to your questions, I do apologize, but I'm just asking if you're looking for strategic partners now.
100%. 100%. 100%. I've actually got a guy in Korea today, and he's stuck there, poor fellow. He's doing the rounds now.
Excellent. Well, Joe, that wraps it up for us. So thank you so much for joining us, for getting up early and giving us this presentation today. We really appreciate it. Look,
I hope you found it interesting. I tried to make it as interesting as possible. I appreciate and value everybody's time. Look, if you have questions, please reach out, send me an email, talk to Neil. I'm happy to talk to all of our shareholders.
Perfect. We're getting lots of love for you in the Q&A now. So thank you again for taking the time to join us today. And we will move now to the end of the presentation.